All right, guys, good morning. And I want to welcome you to our continuation of the consolidation that we have been doing. We started basic consolidation, and this one is to continue basic consolidation. So we tried using the basics to actually solve a problem and we balance it. Now, what we are going to do is to try and look at the various areas where the examiner is likely to trick us. Now, in these areas, we have about 7 things that we are going to talk about. And they will be testing you on how you find your purchase consideration and all those stuff, how intra-group transactions are dealt with and stuff. So straightforward, let's move on. Let's move on to the tricks that they can use to bring to our exams. We are going to deal with about 7, 8 things. We are going to talk about one. We'll be looking at the purchase consideration because they can be stated in different ways, and we need to know all the tricks surrounding it. All right. Then we will be looking at number 2, if it is a mid-year acquisition. Okay. Then number 3, we'll be looking at adjustments. All right. So the adjustments we have 2 types. We may have uniform accounting policy adjustments, and also we have fair value adjustments. Okay, so that is that. How do we treat all those things? Then we will be talking also about intra-group transactions. Mind you, we are building ourselves to solve consolidated statement of profit or loss. Consolidated profit statement of profit or loss and consolidated statement of financial position. That is what we are trying to do. But today, my focus is on consolidated statement of financial position. All right. And so these are the tricks they can bring. When we come to the intra-group, we'll be talking about cash in transit. We'll also be talking about inventory in transit. Okay, and because of this same intra-group transaction, it will give us something we call provision for unrealized profits. Provision for unrealized profit to worry about, okay? So that is what we'll be doing. So these are, you can see I've made it 5, but we have 2 here. We also have 2 here. We expand it, it's like 7 or 8 things that we are going to look at. And I need you to stay with me because these sides are very, 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 very important. Okay, they are very important. So number 1, let's look at the purchase consideration. Now the purchase consideration, there are so many forms it can take. It can take the form of share for share exchange. And I always tell my students that each of them has effect. So anytime they use share for share exchange, bear in mind that there will be something new, share for share exchange, I always say that it will give rise to share premium. Okay, so know that. Number two, we'll be looking at deferred consideration. But here we are looking at deferred cash consideration. And later on, you will see that it will give rise to what we call unwinding finance cost. Okay, so immediately in the question, you have a share for share exchange. If you know that, if I'm doing this, then there will be share premium to bring in. Immediately you have a deferred cash consideration. You should bear in mind that there will be unwinding finance cost. Okay. Another form the purchase consideration can take is contingent consideration. We will look at it. Well, the initial measurement is like we have to do it in fair value. All right, the deferred consideration. But that one too, like I've given you the effect of things that are to come. You have to also check and also be having at the back of your mind that deferred consideration will actually give rise to, may give rise to gain on bargain. All right. So once I start explaining it, you get to know what I'm talking about. All right. It may give rise to that. Then we have cash. As for cash, it is straightforward. All right. Cash is straightforward. You debit your purchase consideration, you credit your cash. Yeah. Then the last form the purchase consideration can take is in the form of loan notes, right? Which is liability. And also bear in mind that if they are charging some interest on the loan, you have to do some cancellations. Okay, so that is that. All right. So bear in mind, if they give the loan and they give interest, all right, you have to be concerned because they are together now, as at the time they bought it, they purchased it. And as such, they can't be taking interest. You can't give loan to yourself and be taking interest. All right. So that is that. Okay. So since we are looking at the share for share exchange, the purchase consideration, I mean, then it means that let's just open a fresh board and start with how to deal with those things. Okay. I'll give you some steps in trying to deal with all these things. And once you find, so the example that we did earlier is so basic, all right? But there can be tricks in your exams. They will be expanding it. And that is what made the consolidation a bit difficult. So if you also know how the tricks are dealt with, even here, then in your exams, you are ready to face it. Okay. All right. So let's now take them one by one and see. Let me show you the steps you will deal with it when it comes in your exams. All right. So welcome back, guys. I had to be off small to open this data. All right. So you can see in my book, that if there is a share for share exchange, okay, the shares are priced at acquisition. Okay. All right. They are priced at acquisition at fair value. Now, the parent will use his own share to buy the shares of the subsidiary. Okay. So if you want to go through the steps that you have to use in terms of deriving how the share for share exchange is, and that is what I have done here for you. You need to go through the following steps here. Okay. And like I said, once you go through this process, the share for share exchange introduces a concept of share premium. What is a share premium? The amount that you get on top of your ordinary share price. All right. So that is that. Now, the steps are number one, you first need to calculate the number of the subsidiary shares that has been acquired. Then you will calculate the number of the parent share that they issue to acquire the subsidiary share. Then you now found the value of the parent share, all right, that they have issued. Okay, then please, this part is very important to me. Always try to pass your journal down, because that journal is going to be the subsequent double entry that you'll be doing. Okay, so you will see how this thing pans out as we move on. So what I'm saying is that if there is a share for share exchange, all right. So let's close this thing now. So one, we are dealing with purchase consideration. And we are dealing with first one, share for share exchange. And mind you, I said it will give rise to what? Share premium. So know that. Just put it at the back of your mind. Now, the steps that I gave you when you are doing share for share exchange is that step one, you need to what? Calculate the number of the subsidiary shares. The subsidiary shares that has been acquired. Okay, then step two, you have to go on and calculate the number of the parent share, the number of parent share that they issued, all right, to acquire. Okay, then step three, you need to value the parent share issue. Okay, and here you are using the fair value at the time, fair value of the share at the time of acquisition. And mind you, we are talking about the parent share here, not the subsidiary. Please take note of that. It is advisable you then go on to pass a journal entry, which will help you in your double entry. All right. I mean, how at the end of the day you are going to debit somewhere and credit somewhere. Okay, so these are the steps you need to go through when there is a share for share exchange. Remember, it will give rise to a share premium. If you pass your journal, you say, so this is what I want to do. Okay, yeah, hope you can see this. And this is the procedures that I've mentioned for you. All right. The most important thing here is that after you've passed it, there is introduction of share premium. So know that. Okay. Now let's take these examples. Let's take this example. Now they say that the parent has acquired 12,000 one Ghana cedi share in the subsidiary, but issue 5 of its own share, which is also one Ghana cedi share, for every 4 in the subsidiary. All right. And they now go on to tell us that the market value of parent share is 6. All right. So that is the value as at the time. Now, when you see this, don't panic. All right. Because you're going to see it a lot. Only if the purchase consideration is a share for a share exchange, you are going to see it a lot. So what do? I gave you the steps. Step 1, calculate the number of the subsidiary shares acquired. This question told us that the number of subsidiary shares that has been acquired is what? 12,000. Okay, so number of subs shares acquired, we have 12,000 shares. Then step 2 is what? The number of parent share issue. Number of P shares issued. How many number of shares that has been issued? Now watch this. Here it becomes very tricky. All right. Now the number of subsidiary shares that are acquired is 12,000. All right. And I told you that you have to calculate the number of the parent share that they issued for the 12,000. So if you read here, they said that they did by a share for share exchange 5 of its own shares for 4 of every share they have now in the subsidiary. Now, the number of shares they have in the subsidiary is the number they bought, all right? And yeah, so you say for 4 shares out of this acquired shares, the parent said that it is giving 5. 5. So this is how you quote it. So when you go through to do this, you have what? I think you have 4 into 12 is 3,000. 3,000 then multiplied by 5 is giving us what? 15,000. So we have 12 over 4 multiplied by 5. It is giving us 15,000 shares. Okay, giving us 15,000 shares. Now, what is the value of this P share? Step 3. Value of P share. The value of P shares will now be the 15,000, which is at the market value, 6. All right. So if you multiply then by 6, the amount you have is 90,000. And here it is in money form. All right. So this is what is going to your capital. But hold on. I told you that it brings in something we call what? Share premium. Actually, the value of the P share, all right, is 1. So it means that the 15,000 multiplied by 1 cedi, which is 15,000, and the same 15,000 number of shares multiplied by, so it means that the value is now 6, but before then, what the value was what? 1 Ghana cedi. So the 1 Ghana cedi side is the one that will go to your stated capital. Then the 5 cedis that they are paying on top of the 1 Ghana cedi to make the whole share price 6 here is, so if you are 15 multiplied by 5, it's giving me 75,000. And this 75,000 will be introduced in our share premium. So together, you still have your 90,000. All right. So that is how you have to split it. Okay. You need to split it. Step 4, we say pass the journal. How do we pass the journal? We debit our purchase consideration. 90,000 is what we are paying. All right. Then we credit our stated capital with 15,000 and our share premium with what? 75,000. At the end of the day, our journal balances. So if you are combining, you are doing the console balance sheet or the console SOFP, like we did, when you get to the equity side, after you bring the parent own, you now need to add this one to the stated capital. Then here you go on to share premium. All right, and that one you will record the 75,000. Okay, so that will show up at the equity side of your. But mind you, sometimes the question will tell you that it has been recorded already. If it has been recorded already, then if these two are recorded already, then you use this one to go and do your good work. You are done. If one of these are recorded, then when you go here, you just add the one that was not recorded. The one that was recorded, you don't need to add anymore. All right. Subsequent questions will reveal this to you. Okay, so that is how share for share exchange is like. Okay, so just a quick reminder, you need to go through these steps that I've outlined here. Okay, but make sure you will have to pass the journal to help you know your double entry. All right, let's go on. Let's look at another example here, illustration 6. All right, so they said that Harry purchased 80% of the 10 million ordinary share, which is at 1 Ghana cedi. All right, so he purchased 80% of 10 million ordinary share of Sally by offering a share for share exchange for 1 for every 4 shares acquired. The fair value of Harry's share is 3. What are the steps? Number of S shares acquired, subsidiary shares acquired. And how many is that? They bought 80% of the 10 million, which I believe will be 8 million, right? So that is that, 8 million. Now, number 2, number of P share issued. How many share was issued? There was a share for share exchange over here. They are telling us that for 1 for every 4 acquired, every 4 we have 8 million. So 8 million we bought. So every 4 acquired in this 8 million, they are having 1 in addition. Okay, so that one means that we do this, we issued our own to be, all right, 2 million. What is the value of this 2 million? What is the value of the 2 million? We know that the share is 1 Ghana cedi share. Okay, so here we can now segregate the 2 million multiplied by 1 cedi, which will give us what? 2 million. All right. Share price being 3 cedis means that we are paying 2 cedis on top. Okay, so that one is going to give us how much? 4 million here. Because at the end of the day, it means that we issue 6. All right, this one is going to our stated capital. This one is what? Our share premium. If you are to pass the journal, what is going to happen is that we are going to debit our purchase consideration with 6 million and credit stated capital with 2 million and share premium 4 million. That is how we balance it. Know that this one will go to the equity side in the SOFP, and at the same time, this one. It's not difficult. You'll keep practicing. You see that it's not really difficult. All right. So that is that. That is that. All right. So let's move on to the next one, which is deferred consideration. Okay, so how do we deal with deferred cash consideration? I think there's something I need to bring to your attention, which normally doesn't appear in your exams, but watch this. Expenses in combination, in consolidation, the time that you are coming together, such as the lawyer and the accountant's fee, are written off as incurred. All right, so that is what you do. Now, you say that, however, IFRS 3 requires that the cost of issuing equity are treated as deducted from the proceeds from the equity. All right, so that is what IFRS 3 tells us. Okay, the issue costs, all right, are treated as a deduction from the proceeds that you get from the equity. So we say that share issue costs would therefore be debited to the share premium. Note that in case there is any. So that the share premium that you have, if there is any issue cost in the question, then you will deduct it from the share premium. Please note that. Okay. So issue costs of financial instruments are deducted from the proceeds of the financial instrument. So please deduct it. All right, deduct it. Because listen, you are the one issuing as a company. You are not the one buying. Okay. Remember, if you are the one issuing, it means that you are the one going to receive. All right. So be careful. So if there is any cost you incurred at the stock exchange commission before people bought your shares, deduct it from the share premium. Very, very important. Deduct it from the share premium. All right. So that is that. Now let's go and see how we deal with deferred consideration. Deferred consideration. Now, in deferred consideration, what you need to do is that you have to PV the deferred consideration. Okay, you have to PV it using the formula, the present value formula, which is 1 over 1 plus R, or raised to the power n number of years. Okay, that is what you need to do. Okay, and then subsequently, you need to now what? Debit finance costs, all right, and credit deferred what? Liability, deferred consideration liability. Okay, so that is what you're going to be doing. All right. So when you discount it, you see that it will give rise to what I said, unwinding finance cost. And that is what you see here. Okay. So that is that. Note that the adjustment does not really impact the fair value consideration. Okay. It does not impact it. So note that. All right. So let's look at how that one to work in terms of the numbers. All right. So let's go to the manual and look at some questions. All right. So this is an example. You see, wow, this is an example. You see. So the parents acquired 75% of 80 million ordinary shares, one Ghana cedi, on 1st January 2016. It paid 3.5 per share and agreed to pay a further 108 million on this day. So we have 1 year. All right, they will pay the balance in 1 year time. Because we will need a rate to discount, they've given us 8%. So you see, since we are preparing the financial statement to 31st December, you will have to PV this thing to this date. And now that is what you have. So they said that they bought 75% of the 80 million shares. So here you see 75% of the 80 million shares. Remember the value of that time, the value was 3.5. So when you multiply, it means that this is the amount. That is the cash part, all right? Immediate payment. Then the deferred. So this is what I told you. So you have 1 over 1 plus Rn. So this one, you can always replace it by the future value, all right? The future value. And the future value is this 108. Here the N is just 1 year, so that is this. So that is what you see quoted here. You can raise to the power 1 if you want, but it's still the same, which gives you this, and you have this number. All right, so that is what you need to do. That is what you need to do. This is a cash, so you don't need to worry yourself about it. That one is purely cash. All right, so if you want to pass this journal, the purchase consideration is 310. Cash is being paid, so we need to credit our cash with 210. This one will go to where? Deferred liability, contingent liability, which is in your, this is just 1 year. If had it been 2 years or something, then it go to NCL. This is just 1 year. So which means that when you do your SOFP, cash needs to be affected, then this current liability also needs to be affected, unless they tell you that any of them has been recorded already. Okay, so take note of that. Take note of that. All right. Then at the end of the year, I always ask students, if you always PV an amount like this to this, what has happened to the 8? Has it vanished? You need to unwind it, all right? And this one, because it is 1 year, the 8 million on it will now be the unwinding discount, okay, on the deferred consideration. So what do you do with this one unwinding? You have to go and debit your finance cost. All right, so that is what you do. The finance cost will be in the P&L. Okay, so that is how you do. All right, so that is how the step 2 is also done. All right, so this is it for you. Okay, probably we need to take another example so that you understand this further before we move on to another trick. Oh, it's been presented with an illustration. All right, so let's look at this. So Pony acquired 80% of the 30 million share, and it's a 1 Ghana cedi share of Star on 1st January. All right, so the dates are also very important. You need to take notes. This is accounting, financial reporting. But they bought 80% of 30 million. The consideration was through the offer of a share for share exchange. So 2 shares for every 3 acquired, and a cash payment of 1 cedi per share payable on this date. So you see, the acquisition is in January, the money is payable in December. There's a 1-year gap. All right. Fair value of Pony's equity share was 2 cedis at the date of acquisition. We should calculate the cost of the investment. All right. So what do we need to do? There are 2 things here. There is deferred, and there is also a share for share exchange. So let's tackle the share for share. So you do say purchase consideration, and you say share for share. Now in the share for share, number of S shares acquired is how much? We have 80% of 30 million. And what is 80% of 30 million? Then you have 2.4 million, or 30 million, 88, 24 million. Sorry. That is what you have. Number of P shares issued. There's the share for share exchange. They told us that out of this 24 million, for every share for share exchange, for 2 shares issued, for every 3 shares acquired. So this 24, for every 3 acquired out of this 24, we are all right. So that is how you quote it. Okay, so how do you get 3,824 times 2 give us 16 million? 16 million. What is the value of this P share? And they told us that the market value at that time is what? 2 cedis. All right, 2 cedis. If it is 2 cedis and the valuations were 1 cedi, there is a share premium. All right, so that is what will happen. So it's this 16 million multiplied by 1 give us 16 million, which will go to our stated capital. Same 16 million multiplied by 1, so making 2. So 16 million, which will go to our share premium. We are done. All right. Then let's now go to the deferred. So they told us that the present value of 1 Ghana cedi in 1 year time is this at a rate of 10. Okay. So that is what we have. So this one, we don't need to stress ourselves that much. What is the amount? What is the number of shares that we are talking about here? So they told us that we are going to pay cash of 1 Ghana cedi. All right, 1 Ghana cedi per share. What is the number of shares we acquired? You know, it's here 24,000. So in the contingent consideration, what we see here is that we bought 24 million and the price is 1. So you have 24 million shares multiplied by what? 1 cedi. And this money, the present value of this money is 0.91. Okay, so that is what they tell us. So how much are we going to get? You have 21,840,000. So that is what we have. So in effect, we have this 32 and this one, 21,840. Okay. Now, don't forget that the unwinding interest there, or since this one is 1 year, the unwinding interest is, so we have a rate of 10%. So it's 10% multiplied by this, which will give us our unwinding. And the amount that we have here is 10%, so 21,840 and 2 zeros. So this is what we have. Don't forget, this unwinding will go where? To the P and L, all right? So if we are to pass our journal, you know that the investment is, so if you are 21 and 32 million, I think you having 54,840, or 32, yeah, 53,840. So our total purchase consideration, which is a debit, will be 53,840. Then don't forget, we have stated capital inside, which is a credit of how much? 16 million. You also had our share premium, 16 million. Okay, then there was a deferred consideration of how much? 21,840. Okay, then you need to now debit finance cost with how much? 2,184. Okay, so that is how it is. And don't forget that this same 2,184, the double entry for it is what? Debiting the P&L and crediting the deferred consideration. Okay, so just note that. So deferred consideration, but these ones are the CL part. Okay, you have 2,184. All right, at the end of the day, your journal balance is up. So that is that. All right, so be careful passing your journal so that at the end of the day, you know that this one is going to P&L, especially the CL will see this, the NCL will see the amount. All right, so that is that. That is that. Okay, so that is it for the deferred consideration. Now let's go on and look at the third one. The third one, which is contingent consideration. Contingent consideration. Now, contingent consideration is measured at fair value, all right, at the date of acquisition. It's a consideration that is based on something, okay? So they say like, okay, we will pay you this amount if you meet this profitability. Are you getting it? So we are buying you, but we will pay you a certain amount if you meet a certain profitability. Okay, all right, so that is that. Now, you are, according to IFRS 3, like I said, it is measured at fair value at acquisition. Okay, so the consideration is measured at fair value. Now, don't forget that the standard IAS 37 talks about provision, contingent liability, and contingent assets. All right, don't forget. We need to account for these things under provisions, contingent liability, and contingent assets. Because what you see here is that there is a contingent liability in the form of cash. All right. in the form of cash. If what they promised is cash, it means there is a contingent liability of cash. So how do we do that? Okay, so what we are going to do is that if the fair value change, let's say, so at the date of our acquisition, let's say it's January 1, 2021, and you promise to pay a certain amount, all right, on this day. So you promise to pay them, let's say on 31st December, because that is when you will see the actual P&L, okay? You've promised this amount, let's say 50,000, okay? Now, this promise is based on the fact that if they meet some conditions, all right, and you are using this 50,000, that is the fair value then of the contingency, okay? Now, if new information comes to play, okay, if new information comes to play and you see that, okay, oh, they will not even be able to meet the conditions that we are talking about. Don't forget, you have already gone ahead to use whatever contingent amount to do your working straight, P&L, purchase consideration, working straight, goodwill, sorry, purchase consideration, you've used it. So if new information comes up, what is going to happen to your goodwill that you have done? So the standard says that if the change in the fair value is due to additional information obtained that affects the position at acquisition, like what we are talking about is like events, all right, events after financial reporting. If the new information that comes up that you obtain affect the position at acquisition, then it means that you need to go back and redo your goodwill again with a new figure, all right? But if the change is due to events which took place after the acquisition date, so what we mean is this. So if we use this figure, we bought you on this. If on this date, new information comes to us, then it causes us to have to change the purchase consideration of 50,000. Then we will have to change it, okay, and do a new goodwill. But oftentimes you may have a change after the acquisition date. Then the standard says that if it happens like that, all right, we need to distinguish it between whether the promise, the contingent promise is a cash or it's a loan, okay? If it is a loan, then it becomes a financial instrument, all right? It becomes a financial instrument. So we will account for it under what? IFRS 9, financial instrument. However, if it is a cash contingent consideration that has been promised, then we will account for it under what? IAS 37. Okay, IAS 37. The key thing is that we will not remeasure the equity instrument. No, we will not do that. We will not remeasure the equity instrument. But my point here is that what happens if you've issued, let's say it is a loan note, all right? The contingency is, say, a loan note. And if you have this loan note, and let's say the fair value of this decreased at the time that you were coming to pay to 40,000, what has happened? This is a loan note. So a loan, so you were going to pay a liability of 50,000. At the end of the day, you realize that, oh, my liability is actually 40,000. What happened to the 10,000? What happened to the 10,000? You remember IFRS 9, financial liability? The default one is what? Fair value through what? P&L. Do you remember that? Okay. If it is fair value through P&L, then this 10,000 is now going to be a gain, a bargain, all right, which we call gain on purchase consideration. Because I was actually going to pay 50, I realized, oh, it's just 40. Then it means that I have gained, and therefore this 10,000, okay, is going to be in my workings 5. I will add it. because that workings 5 is retained earnings. And retained earnings is what? P&L, cumulative P&L. So if it is fair value through P&L, all right, then I'm going to add it. Under normal circumstances, it should be added to like an other income sort of. And the workings 5 is the workings for P&L, all right, with group reserves, which is group retained earnings, all right. So you have to add it there as a bundle. What if it increased? Then it means that you have more liability, right? You have more liability. If it is 50,000, then the 10,000 means that your liability has what? Increased. Okay, so that is that. That is that. All right. So take note of these things because we will be meeting them. We'll be meeting them. All right. So that is it. So if this one was not a loan note and it was cash, then it means that you have to apply provision. All right. If you have a contingent liability, all right, then it means that depending on whether it is remote, it is probable, all right, to happen, then you know what to do from there. If you have to increase your liability, you recognize the additional liability, then you do. All right, so that is that. We'll meet these things up in the question. All right, now that is the 3. And it has combined the loan note. Okay, so the loan note is just so the 4th one we wanted to talk about was cash. All right, as for the cash, you multiply, and I think you saw that you multiply the value, the price, share price, by the number of shares acquired. And the double entry is what? Debit the purchase consideration, credit cash. All right, so that is that. The 5th one is when they use loan note. All right, loan note is the same. You will debit purchase consideration, then you credit what? Your liability for the loan. Remember, if the loan is to the subsidiary, you will have to cancel off interest on loan. All right, so that is that. So watch out for these tricks in your exams. You will be fine. Fine. You'll be fine. Okay. I think there's a question here. So you have all this information. Then the important part is that we are testing your purchase consideration. And they said that P acquired 60% of SAT shares. All right. When the retained earnings was 5,000. When the retained earnings was 5,800. P paid 5,000 in cash. So it means that the first one you've seen is cash. But they also issued 2 CDs. They also issued 1 Ghana CD share for every 5 acquired in SAT, and agreed a further 2,000 in 3 years' time. The market value of P shares on that date of acquisition was 1.8. So here you see how many. In this question, you see how many do you see? You see cash, you also see share for share, and you also see deferred. So it means that in the question, as much as they want, they can bring. All right, so just be careful. So here for the cash, you are good. And they said that the cash is paid. All right, it's paid. And you could see inside here that when we were recording, you saw here that the cash has been recorded. This is the cash, 5,000 that they recorded. So that is it. So you don't need to go into your SOFP and record the cash again. As a matter of fact, instead of going to record a credit to the cash, you just cancel it with this debit. All right. So you will also not see this investment again. All right. So that is that. That is that. Okay. Can I work this question with you at least so that I will know that you've done something today? So you have to read this question carefully. Then, so that at least I know that we actually went through the purchase considerations. All right. Okay. So stay with me. Read through your question because I'll have to open a fresh board to deal with this. So we have these things relate to part and SAT, but let's check date, 31st December. All right. Now, what we need to go through and do is come here because we've seen this that much. So they said that they purchased 60%, okay, 60% of SAT. And what is SAT? SAT is here. The ordinary shares is what? So straight away, we know that the number of shares that they have is a link between this and this, meaning it is 5,000 over 1, which gives us 5,000 shares. And it is out of that we are going to purchase 60%, okay? And this is the retained earnings at acquisition. And we pay this, we want on to do all these things, all right? And they said that for the purpose of our PV, they gave us interest rate to be 6. And they said that P uses the fair value method. And anytime they use fair value method, rest assured they'll give you the fair value. And so at the date of acquisition, the fair value was what? 570. All right, so that is what 5750. So that is what you have. Now, let's go on and deal with this question. Okay, but I will need you to look at the question very carefully because we don't have that much on the board. We will have to go and create our own board to deal with this. Okay. So now let's create our board then. Remember the steps. Remember the steps because we are meant to, let's see the requirement, which is very, very key. We are meant to prepare the financial state as at this date. Then it means that we may need to adjust something in the question. Yeah, because they give us 31st December. Okay, we may need to adjust something in the question so that it befits what we are doing. Because if what we have is in December, it might look like there are some half-year stuff happening inside there. So let me correct the question. Then we can move on. Okay, so I think here should be June 2018. All right, okay, so that we can have it in perspective. So it means that this is the opening. Okay, this is the opening. That's the opening. Then it means that they bought it on the very first day. So full year we will have here. Now, how do we approach these questions? Remember, I showed you the 5-step approach. So step 1, we have what? Group structure. So the parent is part, subsidiary is SAT. So the purchase date will be 1st July 2017. So it is 1 year, full year. And the percentage of ownership, they said we bought 60%. All right. So this is our first workings. You can't get this thing wrong. You can't get this thing wrong. So full 1 year. Workings 2 is what? Fair value of net assets of the subsidiary. We have at acquisition, at reporting date, then what? Post acquisition. We need to make sure our workings all enter this place. Then we start with what? Stated capital. Let's go back. So here, once you are doing this thing, you need to look at the equity structure, all right, of the question. And the focus is on subsidiary. Workings 2 is subsidiary, please. Just make sure you are focusing on the subsidiary. And they told us that the subsidiary has stated capital of 5,000. Retained earnings at reporting date is 7,200. This is what you see. I told you that the reporting date, you always be seeing it here. Okay. Then we ask ourselves, where is the retained earnings at acquisition? This is the date of acquisition, and they told us that the retained earnings here you are at acquisition. And we have share premium, but subsidiary doesn't have any share premium. So you don't bother yourself. Maybe if we do the share for share exchange, we will get one for the subsidiary aspect. Then we will add it when we are doing our balance sheet. So here we have 2 components, 5,000, 7,200, 5,800. Let's go back. So stated capital was how much? 5,000. At acquisition, don't forget, it maintains as reporting, so no movement. Retained earnings, we have 5,800 in the notes. At acquisition, we have 7,200. So there is a movement of how much? 1,004. Okay, so that is that. We don't have more of the adjustments in here. So these were the only things that we were told. So we need to go on and close this thing. We have 10,800, which we will use to work our goodwill, working straight. We have here what? 12,200. Then here we have 1,004. All right, so that is that. That is that. Okay. Working straight, which is what? Goodwill. Don't forget, we will share this thing with the at workings 4 and 5. All right. Goodwill, we need our purchase consideration. And the purchase consideration, don't forget, we have cash paid, which was how much? 5,000. Okay, cash was 5,000. So that is what we've dealt with. Okay, now, what about the other ones? So we have cash is paid. Then there's a share for share exchange. How do we do share for share exchange? Value of S shares acquired. Sorry, number of S shares acquired. What is that? We have 60%. Don't forget, and 60%, like I said, the link is here, which means that if it is 1 Ghana cedi, then it means it's 5,000 over 1. We are getting 5,000 shares. Note that if here is 0.5, divide, you are having 10,000. So be careful. So we have the share for share exchange is two shares for every 5. 2 shares for every 5. All right. Note that 2 shares for what is the market value of the share at the date of acquisition. We need that. So we know that it's 2 for every 5. So what is the market value of the share at the date of acquisition? The market value of the share at the date of acquisition here we have here is 1.8. All right, so that is it. Keep that in mind, 1.8. So we have cash. Then the share for share, number of S shares acquired. How much is that? It's 60% of the 5,000. What is 60% of 5,000? We have 60% of the 5,000. We have 3,000. P share issued. What did they say? 2 for every 5. So it means that we have 3,000 over 5 for 2. Okay, so that is it. So what do you get? 3,005 for 2, you get 1,002. Okay, so what is the value? The value we are told is what? 1.8. And don't forget, it means that stated capital will be 1 multiplied by 1,002, get 1,000. Share premium will be the 0.8 by 1,002. So 0.8 times 1,002, you have 960. So meaning that this one put together will give us what? 1 is what? 1,002 plus 960. You are getting 2,160. So that is the one I'll show up. All right. Then not only that, there was a deferred consideration. What did they tell us? They said that they will pay 2,000 in 3 years' time. 2,000 in 3 years' time. So it means that we need to PV it. What is the cost? 6%. So what are we going to do? So here, you have to show all these things in your workings, all right? So remember, it is what? Don't forget. And so here, you are like, it's 2,000 over 1 plus R raised to the power 3. Okay, so that is what you do. Let's do it. So what is R? R is 6%. 1 plus 0.6 raised to the power 3. Yeah, so then you do 2,000 over your answer. Okay, so what I'm getting is 1679.238. Okay, so if I want to use the nearest whole number, then let's go by 1679. Okay, so this is what you are going to do there. But don't forget, you have to unwind each year. Okay, unwind each year. How do you do that? Unwinding first, the year we are in is 6,000 multiplied by this. 66% multiplied by that, and that one will give me, if I round it, it is giving me something like 101. All right, so just take note of these. We will need them. So deferred consideration was what? 2,000 over 1 plus 0.06 raised to the power 3. And that gave us what? 1679, right? 1679. So we total. So what do we have? 1679 plus 2160 plus 5,000. What we are getting is 8839. All right, 8839. Okay, don't forget we are continuing. So what do we need to bring? Add what? Fair value of NCI at acquisition. It is fair value. So the question gave it to us. How much was that? We had NCI at acquisition 5750. Okay, so that is that. 5750. Put together, what do we have? I have 14,589. All right, that is what I have. Then you less what? Fair value of net assets at acquisition, which is derived from workings 2. Here you are. Less it gives you 10,800. There is no attributable goodwill. Okay, then there is no impairment. If we take our 10,800, what we have is 3789. So that is our goodwill at acquisition. There were impairment, you reduce it by the impairment, then you get what? Goodwill closing to SOFP. Let's go to workings 4. Workings 4 is about what? NCI. Okay, NCI. That is what workings 4 is about. Now, we have NCI at acquisition, which is coming from workings 2. Was given in the question. Okay, so that one is what? 5750. Then NCI share of post-acquisition profit. Here, if you bought 60%, then NCI will be what? 40% multiplied by 1,004, which gives us how much? So this 1,004 is coming from workings 2, so we have what? 560. All right. There was no attributable goodwill. There is no impairment that they will share. So when you add, you get what? 6310. Let me make it cleaner. 6310. And that is our NCI. Workings 5. Group reserves or retained earnings. What do we have? We have the parent retained earnings. So part retained earnings, which we are picking everything. So how much was that? How much was that? So you have to go back and remember and or revise your format. Very, very important. Okay, so his own is 12,500. Make sure of that. Make sure of that. 12,500. Okay. So you go there and slot it in there. $12,500. That's fine. Then CI share of post app. We do 60% times the 1,004, which is from working stool. When you do 60% of the 1,004 and 60% of 1,004, I have 840. All right. There is no PAP. We've not gone through that. There is no goodwill impairment, nothing. But don't forget, there was an unwinding. So we need to less unwind. 1 year's unwinding financials. I think when we calculated it, what was that? Okay, so this is it. And we calculated the unwinding by applying our 6% on 1,679. So what did we get? 100.74. And we rounded it to 0.101. So you check your format. This one is a deduction you need to do. Okay, there's nothing else here. You can close this. Okay, so we have what? When you combine this together, you should have 13,239. All right, so that is it. Once you go through these workings, you can now sum it up and do your balance sheet. Don't forget, we have goodwill here. This one, workings 5, which is group retained earnings. You pick this one. Okay, so can we prepare our balance sheet now? Yes, let's prepare our balance sheet. Okay, so we are talking about which group is that for part group. So you now say consolidated statement of financial position as at is what 30th June 2018. And we put our currency there. We are good. What do we start with? We have NCAs, intangible NCAs. We had goodwill. I think this thing is too far. Well, let's go on. We have goodwill, which is coming from working straight. Please, this is how you are supposed to present it. And the goodwill we have 3 what? Let's check it out. Where's our goodwill? 3789. All right. 3789. And this one is so let's put these figures in mind. Okay, you can write it somewhere. Okay, so those are the figures that we need. 3789. And we have this 6310. So put that one to there. Don't forget here too is 13,239. Okay, because we will need them. And when we passed our distance, share premium was how much? 960. Take note of that. Stated capital 1,002. Okay, so that is how you need to take care of that. Okay, so that is that. There was cash. Okay, there was cash, but the cash, make sure it was erased with the investment. So take note of that one too. All right, so that is that. Okay. So let's go back to our board. This thing is not loading. It needs loading, yes. But I think we can even use this we have here. Yeah. So these are the things. Because we are going to combine things, why not do it here? So the NCA, we had goodwill, and it was what? 3789. All right, so that is what we have. Then we have PPE here. And the PPE, this is how you do it. So 15,000 plus 9,500. Please show these things in brackets. If you don't, I've already told you that whatever you put here doesn't make any sense. You are already wrong if you don't do this. So you have to do, you have what? 24,500. Okay. The investment is cancelled off with the cash. Okay, so it is off. Right. What we need to bring in there is our what? Current assets, which is 7,000 plus 5,000. The fact that I'm seeing it here, but I'm still writing it here, tells you that you have no excuse in your exams to just use calculator to punch and write. So please be very careful. Okay. So how much is that? We should have this plus this should give us 12,000, right? It should give us 12,000. Okay. Let me confirm what we have here. Okay, so I think it's fine because this plus this gives this. Okay, fine. So together gives us how much? So you have oh, I'm seeing something here. This one is correct. Is there so this part is my worry. There's something wrong with this question. So 12,200 plus 500 plus 1,008. Okay, it's fine. Balances off. So let's go on with this. So you have 3,789 plus 24,500 plus our 12,000. I think I've seen where the error is. This is it. If you add 15,000 to 5,000, you get 20. So this thing, so pardon me, guys, this has to be 7,500. Okay, so pardon me. So this one is 7,500. So here will be 12,500. All right, so that is that. So 12,500 because this thing doesn't balance. Yeah. All right, so that one will give me 4789. Okay, 4789. That one should be our balancing figure we are looking for. Now let's come to equity and liability. So let's look at our equity. So that one, we have share capital. We have 6,000. Don't forget, this one has been bought off. So we have 6,000. And when we did in our, so please, here to show it working straight. What we did in our working straight purchase consideration, we realized that we should bring in 1,002, all right, from working straight. So you can go back and check that. That gives us here 7,200. Share premium, there's 4,000 here. What we also did showed us that we need to add 960. Okay, so it becomes 4,000 what? 960. All these things are shown here in the workings, which I told you to keep in mind. These are them, 960,000 too. All right. Okay. Whoa. See the downside of doing it this way. Oh, wow. 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 Okay. So let's see if we can go back to our board then. I think we even started it somewhere. Yeah. We will have to create a new one. It's two down. I'm using shorthand now. As at, sorry. And we have, so we brought in NCA. We had goodwill, right? Which is working straight, where we had 3789. Then the PPE, which we had to combine 15,000 plus 9,000 to give us 24,500. And we had the investment. So let's just show it as 5,000 minus the cash, 5,000 gives us nothing. So we have cash or current assets. I think that was what current assets, which combined, I said it's 7,500 because we made the adjustment there, the error. It gives us 12,500. And together, we now had what? 40,789. And we started with equity. So stated capital, we had to pay 6,000 and add 1,002 from workings three to give us what? 7,200. And we said share premium too. There was 4,000 there. And we had to add how much? 960. Makes it 4,960. Don't forget, then we have group retained earnings from workings 5. And that one was how much? I think for that, we may have to go back. Please bear them in mind, okay? So we had 13,239. And we also have what? 6,310. Okay. So that is what we have. Workings 5, 13, 2, 3, 9. Then we have NCI, workings 4. Workings 4, it gave us 6310. Okay, so let's add them up. This thing has shifted down. So we have 6310 plus 4960. We also have 7,200. What I have here gives me what? 31,709. Okay, that is what I have here. Okay, for want of space, I'm bringing the liability here, all right? And the liability, we have what? What? The NCL, non-current liability. Let's check our question. So we have what? 1,500. Don't forget, there was a deferred, okay, deferred consideration, which we need to bring in. Then we have current liability of straight away this. Okay. So let's put the figures there. So here we have what? 1,000 plus 500 plus the deferred, which is 1,680. All right. So what would that give us? 1,005. 1,005 plus 1,680. And that gives me what? 3,810. 3,810. 3,180. Sorry, 3,180. 3,180. Then I have my CL, which was 4,000, right? Plus 1,008. And don't forget the unwinding that we have. All right, that one said you can actually, so you have 101. Okay, so that will give you what? 5,101 plus what do you have? Plus 4,000 plus 1,800, which gives me what? Oh, sorry, the unwinding is yeah, it's a liability. We need to add them up. So what much do we have? We have 5,901. 5,901. All right. So that is what we have here. Okay. So how much do we have now? I think the roundings. All right. So we have 31,709 plus what? 3,1. The deferred. I think we've rounded it here, which we shouldn't. Yeah. That is what has happened. So scratch that. Let's go back and see our deferred, because I remember it was 1,679. Yes, 1,679. All right, that is what we've done. 1,679. This is it. Where are you? Where are you? deferred. 1679. Here you are. Deferred. That's the corresponding entry. This thing can be worrying. I hope it will not shift down again. Okay. So we have, if we combine it, we have 1000 plus 500 plus 1679. Okay, so we actually have what? 3179. Then the CL that comes in, we have 4000 plus 1008 plus our unwinding. Which is how much? 101. Is that it? Okay, I think that's it. Okay, so what do we have? Four plus 18 plus 101. Have we left something out? We have 5901. Okay, if that is the case, let's just sum it up if it balances. We have 5901 plus 3179 plus don't forget we have the equity component here. It's just want of space. Okay, so we have 31709. Does it balance? Yes, it balance here. 789. So that is that. That is that. So you just need to go through and revise it. You will have it. Okay. So what you see in here is these two main things. When there is a deferred consideration, it will give rise to this finance cost, which you will debit your P&L and credit here if you pass the journal. All right, that is that. The deferred consideration comes here as non-current liability. It will, remember we said that it will not impact their fair value. What again? Share premium, and unless they tell you that it has been recorded already, okay, then don't forget you need to use the cash if they recorded the investment to cancel off, bring in your workings, and this thing should be showed always. Okay, all right, so that is that. All right, so you can take any question you would want to take at home and try and balance it with these procedures that are. God bless you. Have a nice day.